If we're off and we're running, hello, hello. Welcome to this live session of the Making Sense podcast. Tell you what, it has just never been more needed to try and make sense of the money world. It's all on right now, so we're going to get into it. We're going to figure this all out and look at what is going on and also what this means for us here in New Zealand. And then, once we've figured out what's happening, it's time to break down what that actually means for our money. So, what you should do for your mortgage, your investments, your KiwiSaver, even your job. It's all getting sorted out today. Now, before we do get underway, it's always the case, right? But it's really important that I do remind you right from the top. We're dealing in general information here today. We're going to be talking about what works for most people in most situations. But say it with me now. Personal finance is personal. It's what we always love saying, right? That's the classic saying. It is true though. We haven't gone through your individual financial situation here, your risk tolerance. There could be something in your situation that would change what financial advisors would say to you. So, everything we're talking about here today is the general rules of the game. And if you hear something that you think, oh, I'm not really sure if that's right for me, trust your gut. You know your own situation better than we do. So for individual advice, head to a financial advisor. That's always your best bet. That said, here today, we're going to be diving into the nitty gritty, sorting out as much of it as we can. We've got some amazing questions that have been sent in today. So do drop in more into the chat. We can always take more of them live from you here today. I'd love to know as well, where is everyone joining from? Drop into the chat where you're joining. I am obviously streaming live from my home here in Te Awamutu. Where are you guys coming in from? We've had people from all over New Zealand in the past. We've had people from the UK, from the US, from Australia. So I'd love to know if you're from New Zealand, what city are you in? If you're from elsewhere in the world, welcome. And we can take that into account when we're talking all of this good stuff. Where is everyone coming from? Oh, wow, lots of places. Brisbane, Oamaru, Rotorua, Auckland, Waihi, love it. Christchurch, Taranaki, Auckland, brilliant. Some really good people dropping in from all over the place. Upper Hutt, oh, I love it. I lived in Wellington for years. Christchurch, Ohope. Oh, from Pukawa School, well done. Well, we better make sure we don't waste your lunch break. All right then, team. Well, time to bring in the experts in that case. Let's have a good chat to them. First up, we have the wonderful Mary Jo Vergara, who is a senior economist at Kiwibank. She's going to give us that big picture overview that is so helpful figuring out what on earth is going on. So many moving parts at the moment, so thank you. Your big brain is very much appreciated here. Then we have, if I bring him up here, we have Aaron Klee from AMP. Now, I have had so many questions from people about what is going on with the investing situation. And of course, Aaron's episode on the podcast where we talked investing strategies for 2025, you guys loved it. So thank you so much for coming on, Aaron, and taking some of these questions live again. It's brilliant. And then we have, let me hit my little button, and we've got Katie Wesney from Enable Me, Head Strategic Coach. Now, she has helped so many of you already on various episodes of the podcast. You've loved her. She always gives it to us straight. We love that about you, Katie. So thank you for coming on. And last but never least, we have David Cunningham, Chief Squirrel from Squirrel. Mostly I'm bringing you on because I just want to use that amazing title, David. But of course, we've had so many questions about what's going on with mortgage rates, interest rates, what's going to happen there. No one better. So thank you all so much for coming on. There's some really good strategies that we're going to dive into today. It's going to be good. Now, MJ, we're going to start with you because I think the context of this is everything. Literally, last night I was saying to someone things could change at any moment. Woke up this morning. Has it changed? Indeed, it has. So, please run us through. Donald Trump slapped basically everyone with tariffs of some kind or another. Cue a market meltdown. This morning he's wound back a lot of them, not entirely. Why has this had such a big impact? And particularly, what are we seeing here in New Zealand?
Yeah, I mean it's been such a week. It's hard to think that Liberation Day, so-called Liberation Day, was just a week ago, and it's really since then we've just seen markets being completely volatile. One thing I'll say to begin is it's fun. The fun thing about working in New Zealand is the time difference, and I say this sarcastically because when we're asleep, everyone's awake, and lately waking up, it's felt a bit like a nightmare just seeing all the headlines coming through. But markets have been volatile primarily because of all this uncertainty. This whole on again, off again tariffs. There's a threat, there's a countermeasure, there's a retaliation from China. So all that uncertainty is just not good. Investors don't like that environment. So we've seen this big bout of risk aversion in this kind of flight to safe haven assets. You've seen gold do very well in this time. Equities dumped. The New Zealand dollar is a commodity currency, and it's traded alongside risk, and that's been dumped as well. We got down to 54 cents, around 54 cents yesterday. It's back up to 56. So it's been very, very, very volatile. But yet, because of this uncertainty about what's happening and tariffs, so the uncertainty is one thing. The other thing that people are kind of contemplating is the implications that this tariff agenda has for the global economy, what it means for the outlook. It almost feels like we're winding back the clock on globalization. And the average tariff we were looking at, it's the highest since 1906. So this is some big measures that they have announced, and it does feel like we're winding back the clock on globalization. Obviously, that's not good news for us as a small, heavily trade dependent economy. So it's both uncertainty and just a much dimmer outlook for the global economy that's kind of weighing on markets. But it is very volatile. Markets, as you say, are up 12%. I think Aaron said one time. Is that's kind of the environment we're in. And I think us as economists is probably this is where we thrive. We're probably the only one not having fun in this situation, but it's been fun, and it's not the end. Is probably the big thing to note here.
Well, that's the thing I think, right, where there's been a lot going on. There has been some very real financial damage, but I think there is that risk, right, when the headlines are screaming that it can feel like the end of the world, and it's not that level. It's big. It's serious. We are gonna get through it, though. Um, the uncertainty aspect that you mentioned there, that's the big one when people have been asking me to comment. That's the big one I've been pushing. That's the uncertainty makes it really, really hard for the business community, the investment community, the money world to know what's coming next. Uncertainty is a killer, right, MJ?
It is, yeah. It can, our economy, New Zealand economy, it's starting to grow. We're crawling out of the recession we had last year, but you now overlay this uncertainty of the global economy, and it just makes businesses kind of close up. They'll start to, inaction is what uncertainty leads to inaction, and that leads to just no activity. So it does risk, derailing our economic recovery if people are just kind of focusing just kind of right now, right here, right now, and not thinking about going and building going forward. So it is a killer, yeah.
Mm. Aaron, why has this had such a big impact on KiwiSavers and the share market? Because I think everyone will have seen their KiwiSaver respond to all of this.
Yeah, similar comments from me, but most Kiwi savers are in diversified funds, so they're exposed to many different types of assets, many different countries and different currencies on the way through. So the share markets in particular around the world have been riding a series of waves in the last couple of weeks, essentially to that point around uncertainty or due to uncertainty. And KiwiSaver balances will be down at the moment, but you'll find that maybe it's not as nearly as dramatic as the headlines suggest, depending on how you're invested in your risk profile, because a lot of the news comes out of the United States. We hear about Donald Trump and what it's done to the US share market. The reality is not, you're not only exposed to the US. It's been fairly broad around the world, but yeah, most KiwiSavers are more diversified. They'll have bonds, they'll have cash, they'll have infrastructure, other assets. And for the last week, it was kind of a daily cycle of bad news, and then today that message changed, and the markets had quite a huge update. The S&P 500 was up 9.5%, the Nasdaq was up 12%, and so you're seeing these sort of massive movements day to day, and that's to the point MJ was making, that particularly share markets, they like certainty, and that's certainty around the companies that are listed in the market, what their performance is like, their future plans, forecasts, their people. And in addition to that, markets like to understand the economy and how the economy is impacted by things like monetary policy, which we're going to discuss a bit today, but also government policies like you've been hearing out of the US. And right now what Donald Trump is doing is, and almost on a daily basis, is injecting uncertainty into markets. And markets don't like this uncertainty. And unfortunately at the moment, those who trade in share markets have needed to have their heads on a swivel trying to keep up with the daily announcements out of the White House. And so really the question from here is, or from now is, how quickly that uncertainty disperses, and how will the impact of these tariffs play out, and when and where will everything eventually land.
100%. And I think the thing is, even when we see things like the announcement this morning saying that the tariffs are being wound back, that can still cause this uncertainty where we have this issue of, okay, they're on, they're off, might they come back? It's paused. So even when this is technically good news for businesses, for economies, we can also have this problem where it's still uncertain of what's coming next. And that is Donald Trump's hallmark. He often uses that as leverage in his political negotiations, that you can't predict which way he will go next. So this uncertainty is probably locked in for at least the next few years. I mean, Katie, when you look at all of this and you're trying to get people, you've got people coming to you, trying to assess their finances, make a plan, there's a lot going on, right, that can make people feel stressed. What do you think is the biggest factor right now that people should watch at the moment? Should we be changing our approach to our money right now?
Yeah, such a good question, Francis. And I think the biggest factor people should watch right now isn't the daily market fluctuation or headlines. It's actually their own reaction to them. Research consistently shows that investors who make decisions based on headlines typically underperform the market. So when I sit down with clients, I always redirect focus to their time horizon and personal goals. That's what drives decisions, not market noise. And I think what's changed is the noise level, not the fundamentals of smart money management.
I think that's a really, really good point. I even caught myself doing this as well, where I think it was a couple of nights ago, and I was scrolling through the headlines right before I was about to go to bed, like an idiot. Like, what am I thinking?
Not a
And
good
I
idea.
did that, right? And I've been doing this for years, and I know that things can get overhyped, and I've been in newsrooms, and I know what goes into creating a good headline, and yet I still found myself scrolling and being like, oh, this isn't looking great. And I really had to take that moment of pause, go touch grass, like it's all going to be fine. I do think panic and our emotions in general can be a bigger danger than any of the technical things we could do with our money, right, Katie?
Yeah, absolutely. And, for example, if you were yesterday watching your KiwiSaver balances drop and you have decades to retirement, yesterday's drop was just a minor blip in what is a really long time horizon. So I think that perspective is really important, but also your approach really should be based on your own time horizon. And if you need that money that's invested in KiwiSaver to buy a home, or you're just about to use it for retirement, then you do need more certainty and exposure to volatility. So it's really understanding your plan and making sure it's fit for purpose in terms
Yeah.
of investments and strategy.
100%. Your own individual timeline often has far more to do with what you should be doing than what's going on in the headlines right now.
100%.
David, when we had obviously the OCR announcement, which was originally going to be the main focus of this session today before geopolitical events overtook us, but when you saw the OCR official cash rate announcement yesterday, obviously that has a huge impact on interest rates overall. Was it what you were expecting? Obviously, a small drop there, not huge, but a small drop. And
Mm.
how do you think the average person can try to make smart money moves at a time like this?
Yeah, yesterday's announcement, I mean, my view was they should be moving 50 basis points again to get back to neutral as fast as possible. We've come out of a very deep, very, very deep recession in New Zealand on a per capita basis, and so getting back to neutral really fast, faster, but hey, 25 now, 25 the next month, and so on. And probably the most interesting thing for me out of that OCR movement was the commentary that came with it, because if you read the statement from the Reserve Bank, it was maybe 10 or 15 paragraphs. Let's say it was 10 paragraphs, 6 of those about tariffs and that stuff and what impact it would be on the world. A month ago, it wouldn't have even featured. It's sort of crazy, and I guess, I mean, it's sort of interesting here in that conversation. Strategy is the key thing, and luck shouldn't really play a part in financial outcomes for most people. And I sort of made a little bit of a list earlier on, and I sort of went through the things that are top of mind for me in terms of what's happened in the last 100 years. World War One, the Great Depression, World War Two, the Cuban Missile Crisis, the oil shock in '73, Black Monday, '87 crash, the dot-com bubble, the Asian financial crisis, GFC, COVID, tariff mania or Trump mania is probably barely even a blip, to be honest. And so strategy trumps, excuse the pun, luck, and that's the way we should be thinking. And really the same applies with interest rates and interest rate strategy. So very much the outcome the whole market expected. I think it was described as a commentary doused in dovish commentary. That was a Kiwibank phrase, MJ. But I thought that was really nice, doused in dovish commentary. What that was saying was the world has become more uncertain. Economic growth is likely to be a bit lower than it would have been if we weren't having all this mania sort of at the moment. And therefore interest rates are lower when economic growth's lower. It's sort of proven through history. So I think what we got out of the OCR was what we expected, but perhaps more dovish, and therefore the wholesale markets are pricing an OCR getting down to 2.75, maybe even 2.5, as some economists are calling. For homeowners, it's probably a net positive. Our interest rate is quite probably going to be lower because of this. Equally, unemployment might be higher. But, New Zealand feels like a good place to be right now, I've got to say.
Yeah, I've got to say, yeah. If you're going to be anywhere through all this, I'm quite happy to be in New Zealand for it. Okay, we're going to jump into, there were some amazing questions sent through ahead of time. We're going to rock through as many of these as we can. And as well, for those who are watching, drop more questions into the chat. We can always try and get through more of those live as well. And if I see a certain question popping up more often, then I'll know that that's one that you really want answered. So even if you see it asked, drop it in again, then I know that it's one that's on multiple people's minds, okay? Where were we here? MJ, this one came through from Robbo, who I hear from him a lot. He always has great questions, and I really like this one. He's asked for a kind of overview of how the New Zealand economy is going generally. What can we, as well as individuals, also collectively as a society, do here in New Zealand to make a positive change that benefits all of us economically? What do you think, MJ?
Yeah, really good question. I like kind of the longer term thinking behind that question. These cycles, they come and go, but we do have to kind of have that discussion about where we want to see New Zealand going forward. We have been through a lot in the last 5 years, coincidentally, the same time as I've been at KiwiBank. People at work will probably say they've caused some things, but I won't get into that. But in terms of how New Zealand is going, we are crawling out of this recession. We had a very deep recession, like David said, on a per capita basis, was deeper than the GFC. But we do see the economy bouncing back as a cycle, just like a cyclical rebound. But in terms of our potential growth rate, which is kind of where we see the economy growing if we use our resources efficiently, it's kind of we have it at around 2.5%, which pales in comparison with other OECD countries, other developed countries. And that kind of difference in performance longer term really comes down to our productivity and how poor it's been in New Zealand. We used to be very good in this space. I think one of the top performers, but just over time we've kind of lacked in that space. And I really do have to shout out Reserve Bank Paul Conway's speech on productivity he gave, I think, a few months ago, which everyone should really take a listen to, specifically on this topic. And he basically summarized that New Zealand is a small and distant and capital shallow economy, and that is really holding back our growth. So I think there's so much space here in terms of how we improve our productivity, things around infrastructure, needing to build housing, roads, transport, education, all these things, hospitals, to be more productive. We know we have a big infrastructure deficit in New Zealand that's holding back that growth. I do think also, I'm not the expert here in terms of investing, but maybe thinking a little bit about how we invest in New Zealand. Around 2/3 of household wealth is tied to the housing market, which we know is a non-productive asset. So from an economic perspective, thinking about investing in New Zealand businesses, that could be hugely beneficial from an economic standpoint. So things like Sharesies does make things, investing in New Zealand businesses much more accessible. I think that's the kind of way we want to go if we want to think about our economy longer term. Great question.
Yeah, I think that's a really good point as well. Aaron, one of the things that I've seen around a lot, and a lot of people did also send through this question, so I want to make sure we get it answered, where people saying this time is different. One of the most dangerous phrases in economics. This time is different, but I do understand it feels like a different type of crisis to a lot of people. And when people are saying this, they're saying, looking back at how markets have performed in the past, it's pointless because this is all new. What do you make of that?
I love this question, and I'm glad someone asked it. And a bit like what Dave was referencing before, because in my career I've experienced
Now, Aaron, you are very quiet, I'm afraid. I think changing your microphone may have lost some of your sound. For those on the live stream, could you hear Aaron? Was that just me? Or let me know, because we definitely don't want to lose Aaron here. Let me know if that's also going quiet for you. And I'm just going to live try and change a couple of settings. Let's try that once more. How's that, Aaron? You back on?
Can you hear me now?
Ooh, maybe just try and pull off the headset. We might just, raw dog it. See how we go. All right, let's try once more. Oh, I've lost you entirely. Nope, he's coming back. He's coming back. This is what happens when we go live, team. You get all the behind the scenes. All right, try once more for us, Aaron.
Can you hear me now?
Ah, perfect.
Right.
All
Okay.
right. Thank you so much. All right.
Sorry, I
this
thought
time it's different, is it?
I was hoping it wasn't the background noise problem earlier, but yeah, I love this question, and so I'm really glad someone asked it. And similar to what Dave was saying before, because in my career I've experienced a significant number of crises. And the one common thread with every one of them is that people say this time it's different. And people were saying COVID was different, 9/11 was different, the GFC was different. Or if you want to go back further, like Dave did before, and I love the history and all this, that, the Cold War was different, JFK's assassination was different, the crash of '87. Well, my favourite one of all time was Y2K. If you remember the fury around that, going, everything's going to go to custard the year 2000. So you could go on with many different crises over time, and here's the thing, that the event is usually different. And so what causes this crisis or emotive explosion is the event's different. But in every instance through history, that the market figures it out and it moves forward. That's happened every time in any of those instances. So sometimes it figures things out quite quickly. And I say the market, like COVID, it figured out COVID relatively quickly and recovered quite quickly. And other times it does take longer, but the key thing to take out of that is that our worst fears are never realised in any of these situations, looking back on history. And it's natural to feel anxious or fearful during market downturns. But making decisions based on emotions can lead to poor outcomes, and that's where the history teaches us great lessons and is a great anchor point for when our emotions are starting to influence our decision making.
100% agree with you there. And thank you, by the way, to everyone who's watching who let us know that it was quiet and now they can hear us well. So thank you, team, for helping us work through some of those little bugs. Always happens when you're live. Now, the other one, and I'll come back to you on this one, Aaron, because the flip side of that is another question I got. Someone said, what do we think about finfluencers? So the people with the big online followings saying a really common one here that we've heard a lot, your favorite companies are on sale. Now, Aaron, you might not be as online as I am, but I've certainly seen a lot of that. And my take on it is it's quite a simplistic way of looking at current events, to say, oh, this will be fine, buy up lots. And I think there's a grain of truth, but it's simplistic. But you are the expert. Tell me, what do you think? Is there any way that you would refine that message?
Yeah, well, you taught me a new word. I've never heard that before, so thank you. But yeah, now this is different and dangerous in my view. There's a good reason why financial advice is regulated in New Zealand and most other countries. A lot of people got burnt back in 1987 when private share clubs existed. It was a little bit before my time, but my parents and that generation, a lot of people were joining these share clubs to figure out what shares are they going to buy, and a lot of people lost money in the 2000s when finance companies collapsed. And that really led to regulated financial advice in New Zealand. And it feels to me like a lot of these sort of online forums or influencers are kind of the modern day share clubs from the 80s. Probably the other analogy, it's a bit like someone tipping a horse to win a race and telling you to go bet on it. Sometimes that might work and other times it won't. So for me, I'm much more comfortable making investment decisions based on markets rather than individual companies, because markets can be on sale too. And with investing, diversification is our golden rule, and that's what we live by and believe.
Exactly. I think at times like this, as you really do see the value of that good old diversification, which is simply don't put all your eggs in one basket. Companies, individual companies can and do go bust. And we've seen talk of, healthcare might be targeted next for bigger tariffs. Like, who knows? And that would mean that these healthcare companies could, through no fault of their own, face quite strong headwinds, and even well-managed companies could be in trouble. But if you're putting something into a fund and then you're, investing into the economy overall, you've got hundreds of different companies, then yes, maybe you might be taking advantage of low prices in a way that is less risky. It's not just buy up, chuck money into the market, right? It's have a bit of a strategy and make sure you're factoring risks into it and spreading those risks out if you're going to do something like that, right?
Exactly, and as I said earlier, thankfully most KiwiSavers are well diversified. They're investing into shares, they're investing into bonds, investing into property, infrastructure, cash. So they're getting good diversification through KiwiSaver, and that's why we manage KiwiSaver in that way.
Yeah. Katie, this idea that if we're heading into recession, investments, various assets, they'll be on sale, you can buy up large. Now, disclaimer, I am myself someone who is investing more at a time like this carefully, with guardrails, so it is something where I do think you can take advantage at a time like this, but really carefully. What do you think? Can you make hay at a time like this? Can you do it in a way where you're not leaving yourself exposed to other things going wrong?
Yeah, it's such a good question. And I see, like Aaron, quite dangerous sound bites across the media, etc. And of course, theoretically, buying low is a good idea. but what is low in extremely volatile markets. And Aaron is dead right. Any investment should be part of a wider, well-diversified financial plan to build wealth. If you're thinking of doing something just to make a quick buck, that's not a plan. That is just like playing the lottery. And I think we've got to remember contributing regularly to investments, like the vast majority of us do with our KiwiSaver, regardless of market conditions, means you're buying more shares when prices fall. This strategy removes the pressure of trying to time the market perfectly, which actually is impossible. So likely, if you are investing regularly into KiwiSaver, we're already taking advantage of those low prices, but as part of that well-diversified plan and strategy aligned to your own personal goals.
Yes, brilliant. Very sensible advice there. And of course, something called dollar cost averaging. For anyone who hasn't come across that before, that is exactly what your KiwiSaver does. That's what we're talking about when we're saying investing regularly in these set amounts all through. So if you haven't come across dollar cost averaging before, give that a quick Google. We've also got other episodes of the podcast where we've talked about that. So it's a really good one. MJ, a lot of people sent in questions saying, when might we get a recovery for the economy, for the share market? What are your thoughts on that? Gaze into the very misty, cracked crystal ball for us.
Yeah, let me just bring it out. We are forecasting a turnaround in economic activity this year as the Reserve Bank has cut interest rates. That should lead to that. But it does take time. They've been cutting since August last year, but it does take time for that to feed through to the economy. But we should see growth pick up second half of this year going into 2026. And we're starting to see some green shoots domestically popping up, whether that's household spending kind of going back into a little bit more, seeing a bit more growth there. Housing market is kind of tentatively picking up as well. House prices are up, I think, 0.4% in February. And then on manufacturing as well, we're seeing some positive signs there. So it is in our primary sector as well, agriculture is doing really well. Currently, so we are seeing some domestically some green shoots. A big risk obviously now is the global growth environment. As I said, we're heavily dependent on what's happening overseas, so that's a big kind of shadow of our forecast, and particularly because it's China and the US really going ahead. We talked about those tariffs kind of being wound back this morning, but still the US has put 125% tariff on US on China. So that's a big risk that going forward. Hopefully that's resolved sooner rather than later, but it does mean that we're potentially in a period of some kind of slower growth than we had expected initially. Obviously that's not a good environment for taking on any risk. So I'm not an equity analyst, but I doubt this is the end of volatility. It could be, at least for the US, it seems like they're heading into a kind of stagflationary scenario where inflation, because of these tariffs, might stay higher for longer there, and also that just means a slowdown in economic growth there. And if the US is in recession, it doesn't, I guess, bode well for the global economy again. So for domestically, our economy should be picking up, but we are very wary of what's happening around us.
Yeah, run me through that a bit, because I think that's something that can be underplayed, where now it just looks like mainly the US and China going at it loggerheads. There's still little tariffs, comparatively, on everyone else, but the US and China really going at it. Why do we care here in New Zealand? How will that end up seeping over to us?
Oh, in massive ways. They're the two largest economies in the world. China's our largest trading partner. So it is, when you see this kind of or this disruption to global trade, it doesn't bode well for us as being so dependent on these trade flows. Not only that, Australia is our second largest trading partner, and China is their largest trading partner. So we kind of get doubly hit if we see a slowdown in Chinese growth, which could result here. And another thing is that the US is our second export destination. So it is, it makes it very difficult to kind of trade in this environment. And I think with all this volatility and uncertainty, what we've been saying is to look above the noise. What is the main thing here? And it's about New Zealand having to really needs to diversify our trade partners. We can't just be kind of sticking to the US and China as our largest trading partners, because there's so much potential for disruption there. We should be looking into other markets to kind of, as you know, investing. You need to diversify your fund. The same thing with our trading strategy as well. Look to different areas.
Yeah, yeah. All right. We are going to rip through in general order here. We've got some questions on mortgages. We've got a lot of questions on investments. And then we will go to jobs. Okay, team? So hold tight if those are your interest areas. David and MJ, I'm going to hit you both up on this one. You might have different opinions. Love to know if so. Disagreement is allowed here. But so many people sent me a version of this. If you've got a mortgage right now, what is the smart plan? Fixing, floating, if you fix for how long? MJ, I'll start with you. Do you have thoughts on this, and run us through the why as well?
Yeah, I guess to begin with, most people seem to be on those floating rates or fixed in less than a year. And when I say most people, it's actually around 80% of the New Zealand mortgage book is on that tenor, which is, if not the record high, is pretty close to it to be that short. And I think that's great because as the Reserve Bank's been cutting interest rates, they've been able to benefit from those lower interest rates. Back during the GFC, the Reserve Bank was slashing rates, but everyone was on the 2-year, so that impact was very delayed. This time around, it's a much quicker turnaround. So that's good news. What I can say, I'm not a financial advisor again, so I won't give. No, I will give financial advice. I'll say what I say. One thing, well, we're expecting that the Reserve Bank will have to continue cutting interest rates and potentially even below the 3% endpoint that they had signaled back in February because of all this global disruption. It just, in that time of uncertainty, you do need to see a more accommodative interest rate environment. And so we see the Reserve Bank delivering another 100 basis points of cuts this year to a 2.5% cash rate. And with that, wholesale market pricing's kind of moved in that direction as well, and we've seen wholesale interest rates, which is what retail interest rates are based off, we've seen them move lower. So I think there's potential for retail rates to move lower from here, and when you're kind of hearing that, I guess the tendency is to stay short, wait for those lower rates.
All right. David, your thoughts?
Yeah, the problem with floating rates is that banks take double the margin they do on fixed rates roughly, and so it's painful being in a floating rate at 6.5 or 7 when you can get a 5% rate. As MJ said, 100 basis points of cuts. Well, the market's pricing 75 of those, pretty close to 75 of those. So what's already happened is the market's saying, okay, we're going to have a cash rate at 275-ish. Some are calling lower than that, but you're there or thereabouts. What that translates into for fixed rates, which is what most people in New Zealand ultimately have, either 6, 12, 24 or 36 months, sometimes 5-year, is that they price off the wholesale market. And we've seen those wholesale market interest rates right across the yield curve from 1 year through to 5 years and beyond drop by about 30 basis points over the last 30 to 40 basis points, so 0.3, 0.4% over the last few weeks. What it will probably mean is that you can probably get a 1, 2 or 3 year fixed rate below 5% pretty soon. I think it's only the 2-year there at the moment. Will it fall a lot further than that? Well, history would tell us unlikely. So hey, what's the next couple of years going to look like? Might we see a sub 4% rate? Very unlikely. 450 maybe. So we're all in the zone. We're in the zone sort of already. And if you look back over the last 15 years, interest rates have generally been in that 4 to 5% band in terms of what people have managed to get. So I think what I'd say is erase the memory of sub 3% interest rates in mortgages. That was a unique situation. Parts of the world have negative interest rates. So you had to pay the bank to look after your money. How crazy is that? So that was a COVID unique thing, right? So erase that from your memory. Erase from your memory that you might one day get a 3% interest rate for 5 years. And, history sort of tells us 4 to 5% in a world where you've got inflation running at about 2 is about right. So I guess long story short, Squirrel's view anyway is that a sub 5% rate for 1, 2 or 3 years is a good deal. I've just fixed my mortgage for 2 years at $4.99. I've got a bit more coming up in a few months, and I think I'll go for 1 year, hopefully at $4.99 maybe a bit less. But, that sort of band, spread your risk like anything. It's generally a bad idea to have all your mortgages, your whole mortgage maturing at one point. So, spread the risk, a bit of 1, bit of 2, maybe a bit of 3-year, maybe a bit of floating. But, we're in that zone of where there or thereabouts, the wholesale markets are pricing, that terminal cash rate of 2.5 to 3%. So, that's the thing to remember. Wholesale markets anticipate what's going to happen. So we're already there in one sense.
Yeah. All right. Follow up from Gina, who said, we've just bought a home. We're yet to go unconditional. We will be sorting the mortgage soon. What should we be considering in this current financial climate? Which is an interesting one. That's kind of a similar sort of spin on the question. What do you think are the top things for people to bear in mind and keep an eye on as they're making these decisions? What factors should they be watching?
Yeah, well, a factor is what's your household budget look like? Could you afford an interest rate to go up, for example? Because all these unexpected events happen. What happens if inflation exploded for whatever reason, and suddenly inflation was running at 3% or 3.5%? Guess what? The OCR probably is going up. So first question is, can your household budget cope with a shock upwards and insert a cost? If it can't, then make sure you sort of fix for perhaps a longer term, 2 or 3 years. Secondly is diversification, as I said, spread your risk, don't have it all maturing on one day, because then that particular day that fixed rate loan rolls over, is it going to be going in your favour or not? So, spread it out. Most banks will let you sort of spread, say it's a $600,000 loan, put 200,000 at maybe 1 year, 200,000 at 2, 200,000 at 3. Especially now we've got those rates back below around that 5% level. So diversify. I guess those are the sort of two main things. Think about your household budget. Diversify.
Yeah, I love it. All right, Katie, what are your thoughts on that?
Oh, God, I'm so glad you've asked me, like itching. I was like, oh, I have good things to say on this. And I think that the lower interest rate environment is an opportunity for everyone. And I actually believe complacency is the biggest thief of wealth in New Zealand. And if you are buying your home, or you have been having these higher interest rates, you will have more cash flow left over in your budget. You should be being purposeful with that and increasing the pace at which you pay off unproductive debt. I think we obsess over interest rates and length of fixing, and of course we all want to pay the least amount of interest, but the differentiator for many of us is to increase the pace at which you pay it off. That will save you hundreds and thousands of dollars. And as David said, there's nothing surer than interest rates will rise in the future. We just don't have visibility around that. And if you make progress whilst the sun is shining, that helps mitigate that pressure in the future.
Yeah, love it. That's really good points. We're going to dive into investments now because masses on there. And Aaron, this is really going to be, I'm going to send quite a few of these your way. So we might keep them not fully quick fire, but semi quick fire, because I want to rip through these. From Claire, she says, I'm looking into investing, was wondering with the tariff news if it's worthwhile investing in the S&P 500 or Global 100. Would love to know your thoughts. And I think what she's getting at there, obviously the S&P 500, top 500 companies in the US versus something like a global fund. Is there a better strategy right now in terms of going really wide global, trying to hone in on maybe some value in the US? What are your thoughts?
As I mentioned earlier, diversification is key, and if you only invest in the S&P 500, you're really only exposed to one stock market, the United States. And whilst many companies that are listed on the S&P 500 are global companies, the likes of Apple, Microsoft, McDonald's, etc., they are listed in the US. So by investing in a large global index, you get broader diversification. The one mentioned there, the Global 100, only has 100 companies in it, and they're the largest companies. So maybe the thing to check there is where they are as part of your research, because I had a quick look and 80% of the companies in that index are in the US as well. So you may not be getting the diversification you think you're getting. We invest globally through several indexes, a large one based on the MSCI World, which we invest in about 1,000 companies there. In emerging markets, we invest in another 900, another 80 odd in infrastructure. So, there's broader ways to access the market opportunities that exist.
Excellent advice there, and a really good context on that. The wonderful thing about the share market is how easily you can go really global and how many companies you can get access to so fast. It's not something like an investment property where you're putting $100,000 into one house in one city in one country. And this is the beauty of the share market and why I love it so much. Another curly one here. Someone who said, I'm in a growth fund. We want to use it for a first home. It's already dropped a couple of grand. Should I go conservative? What are your thoughts, Aaron?
Probably can't give a specific view on this one without knowing more about the personal situation, but I'd probably suggest they talk to someone, get some advice really soon. Typically, if you have a short-term savings goal, you would invest in a product or fund with lower volatility or lower probability of volatility. If a deposit's needed for a first home purchase within the next year, we would typically recommend they invest into a cash fund. The challenge here will be that recovering the couple of grand by going conservative now will take a lot longer. So that's probably the conundrum that this person's facing. But as I said before, don't make any emotive decisions and get some help and advice from a professional advisor. You can get in touch and we can get a meeting set up between any of us pretty quickly, I would have thought.
I know, it's so interesting to me. A lot of people will send me questions about their KiwiSaver, and I'll often say to them, have you talked to your KiwiSaver provider first? Because the wonderful thing is, people get really shy about getting in touch with their KiwiSaver provider. We pay fees of greater or lesser extent. We pay fees to our KiwiSaver provider of some amount. Part of the deal is that they can help you. They can look at your situation. They can talk to you about your timeline. So not only is this free to you, you've prepaid. You've already paid for this. Make use of it. And so I think that's a brilliant thing to do. Get in touch with your KiwiSaver provider. Talk to them. As you say there, if you're planning to use it soon, it should often already be in conservative. Once it's already dropped, that's kind of tricky. Can you push off the house buying for a while and wait? Do you need to go conservative to protect any further losses? That's a great thing that your KiwiSaver provider can talk to you about. And David, you must see this all the time with people planning to use their KiwiSaver for a first home. Do you have any thoughts on if someone is planning to use their KiwiSaver soon, is there a good strategy right now? And what do you tell customers? Oh, David, you're still muted.
How do I?
There we go.
Okay, I'm on. Yeah. I mean, it's sad when you see customers that have been saving for their house and they're literally coming up to settlement, and we know they've got KiwiSaver and they go and withdraw it, and then suddenly it's $5,000, $10,000 lower, and you can get that when you've got two, a couple who have both got 50, 60, 70 grand in their KiwiSaver. That's not uncommon now. I mean, it sort of really comes back to just set yourself up right from the start. If your time horizon's 10 years till you think you'll be buying your house, your strategy will be quite different from if it's 10 months or 2 months sort of thing. But the closer you are to the likelihood of buying a house, I mean, it's like your strategy should become more conservative because the goal is different. One, it was to accumulate, to be able to buy. When you're getting close to that purchase point, it's not to accumulate, it's to have and to use, and the big investment then becomes the house. So, what do you do if you've been in a growth fund and you're about to buy a house in 6 months and you've seen all this market turmoil? I think you should speak to an Enable Me financial advisor, actually, because
Thanks, David.
we're at the end of that sort of thing. But it comes back to getting the strategy right at the start. If you've been hurt by the strategy that you've chosen or ended up in, you sort of can't change that. And to sort of say, well, move out yesterday, move into a conservative fund because it might get worse, and hey, if you've done that, you've just lost 10% compared to if you'd stuck with it. So yeah, I mean, it really comes back to getting it right in the first place, and then stay in the course. So get the right course and then stay the course. And as Katie said, pay yourself first, whether it's paying off your mortgage or putting money in your KiwiSaver. They're really simple principles of investment, aren't they, when you think about it?
Yeah, and they don't change either.
Mm.
And I think that asking for help, we're a nation of DIYers. I
Mm.
appreciate that. But the stats, and I'm sure MJ would agree with this, it just does not serve us. Standard mortgage term is 30 years. That is a very long time to be paying off that debt. So I think being brave enough to seek advice on that KiwiSaver, to understand that property mortgage strategy is just so important. And there is very clever people who will have your back in New Zealand to make sure that you will have a brighter financial future.
Yeah.
We see that in KiwiSaver balances. Those people that have sought advice and got help have higher average balances than those that don't.
There you go.
Work
That's
smarter,
really
not
good.
harder.
Yeah, yeah, exactly. Get it set from the
Yeah.
beginning. And I really do think often when people come in and say, this has gone wrong, now what? And it's sort of like, well, now we're in recovery mode, and that's really tricky.
But it's
Um,
never too late, I think, as
mm,
well. So if you've made any of mistakes, it's never too late to course correct, but you do have to take action and you have to have a plan.
100%. And this is why I think anyone who's listening into this and is empowering themselves with knowledge and then using that to give themselves a plan, I think that's really key. We can overrule the panic and get ourselves empowered instead. There's always more you can do, even in tricky times. I
Mhm.
mean, all of this uncertainty, right? It impacts jobs too. And I want to touch on that because I got a couple of questions on that. Businesses get nervous, they might stop hiring. It's already quite a tough job market out there. MJ, I got a question here from Tony that says, seriously, how long until jobs exist again? I've been applying since July last year, and that is brutal. MJ, what are your thoughts on the job market?
Yeah, definitely really tough. The thing about the labor market is, it often lags the broader economic cycle. So you'll see a slowdown in economic activity, but you see that impact on the labor market 9 months or so down the track. And like we had last year, we saw this big slowdown in economic activity. Businesses try to hold on to their staff for as long as they can, and they'll cut hours before they start to cut headcount. And we've already seen that first half play out. I think hours were down around 2.5% on the year, which is quite big. I think again it's like another big number, record number. Um, but we are starting to see that businesses, some just won't be able to hold on for much longer, so they start to cut that 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 headcount. So last year we saw, I think, around 30,000 jobs lost in that year. I think we are kind of getting close to the peak in the unemployment rate again because we are expecting this turnaround in economic activity to come. But again, it will take a bit of time to see labor demand actually pick up. In this time of uncertainty, they may just want to be kind of staying still. There's no appetite yet to hire just yet. I think they need to see or be convinced of a recovery, see activity actually pick up before they say, okay, maybe we'll change our mindset from cutting headcount to actually, adding headcount. So hopefully that does happen in that second half of the year, but it is the last shoe to drop, and we've seen it kind of happening.
All right, well, there we go. So it's hopeful, but maybe not green shoots yet. So fingers crossed. Katie, as someone who helps people build wealth and hopefully make overall smart decisions, question here from Danielle. In this economy, is it smart to seek higher paying jobs or stay steady with the current job? What would you say to a client weighing that up?
Such a good question, and there are a few factors. Danielle, fundamentally, please ensure you are paid what you're worth,
Mm,
especially as a female. And if you can get paid more, likely you should, but you do have to balance that with job security, and that can be industry and role specific. So those are the things that you need to weigh up. My challenge for you, Danielle, within that question is what I know to be true is that for most people, the more that they earn, the more that they spend, and the more they disconnect from you, their finances. So it's not necessarily in the earning more that translates to progress. It's how do you channel what's left over as productively as possible. And I think that's been the universal message within this panel today. Ensure you have a good plan, make sure you pay no more interest, make sure that you're in the right KiwiSaver or investment fund for your time frame, and execute and stay true to that plan. I think that is fundamental. So get paid what you're worth, but make sure that you channel that as productively as possible.
That's fantastic advice. Thank you, Katie. And thank you to all of the experts. We've basically run up on time here. We could have talked forever, but I really appreciate you taking the time out of your busy days. I know you've all had clients getting in touch with you, also wanting to talk about all this stuff. So thank you for taking the time to answer all of these questions and running through it. And thank you as well to everyone who tuned in to listen to our wonderful experts. If you've forgotten their names, I hope you haven't. Mary Jo Vergara from Kiwi Bank, Aaron Clee from AMP, Katie Wesney from Enable Me, and David Cunningham from Squirrel. Thank you for tuning in.